Welcome to the deep dive. Today, we're jumping straight into the latest quarterly economic commentary from the ESRI. That's the Winter 2024 one.
Yep, fresh off the press.
Think of this as your kind of shortcut to understanding where the Irish economy is right now and, what the next year or so might look like.
We've basically boiled down their forecasts, their sector analysis, domestic, international, the lot.
Exactly. Housing, inflation, jobs, public finances, it's
Yeah.
all in there. Our goal, give you a clear picture of the key trends heading into 2025, what looks good, and what are the potential bumps in the road.
Okay, so right away, the ESRI paints, well, kind of a dual picture. They're seeing pretty strong growth in what they call modified domestic demand.
Right, MDD. That's the one that tries to trip out some of the multinational noise.
Precisely. And they're forecasting 3.2% for 2024 and then accelerating a bit to 4.1% in 2025.
Okay, and what's driving that?
It's like I said, mostly real income growth people having a bit more spending power and also investment, particularly in housing.
Okay, but that contrasts with the main GDP figure, doesn't it? Because the headline number for 2024 is actually expected to fall.
That's right. Yeah, the overall GDP projection for 2024 is negative. And that's mainly down to some big intellectual property movements, outflows basically, plus higher imports.
Mm.
But they do see it bouncing back strongly in 2025, forecasting GDP growth around 4.5%.
So it really highlights that difference, that volatility the multinational sector brings to the headline figures.
It absolutely does. You see sometimes quite a big divergence between those big numbers and what's happening in the more, domestic-focused parts of the economy.
And we see that split in performance too, right? The report mentions the multinational dominated sectors have been, well, more up and down.
Yeah, more volatile compared to the
Uh-huh.
domestic side. Although, interestingly, there was a bit of a switch in Q3 of 2024.
Oh, yeah. What happened?
Well, for a while, the foreign-dominated sector was actually dragging things down a bit, but in Q3, it jumped up 4.2% growth in gross value added. So maybe a sign of things picking up there again.
Well, the domestic side just keeps ticking along more steadily.
Kind of, yeah. More consistent, maybe less dramatic growth.
Okay, let's dig into investment a bit. That's another area with that headline versus modified split, isn't it?
Definitely. And again, it's those big IP moves messing with the numbers. The estimate for total investment growth in 2024 is, wait for it, negative 18.9%.
Wow.
Yeah, but that's almost entirely because of those IP shifts, mainly in Q2. If you look at modified investment, which tries to filter that stuff out.
The more sort of real world investment.
Kinda, yeah. That actually saw pretty strong growth in Q3 2024, up 10%. That came after a bit of a slower patch, probably down to, higher interest rates and just general global uncertainty.
So it's really crucial to know which investment figure you're looking at. One says a big drop, the other says solid growth.
Exactly. Context is everything with Irish data sometimes.
And construction.
Yeah.
Always a big topic. How's that looking?
Well, it's had its ups and downs across different bits, housing versus commercial. But the good news in Q3 2024 was growth across all the main areas.
All three, so housing too.
Yep, housing, other building work, and improvements, all positive. And encouragingly, investment in new homes started growing again after a couple of quarters where it had dipped slightly.
Okay, that's definitely welcome news given the supply issues.
Absolutely.
Right, let's broaden out international factors. Ireland's so plugged into the global economy. What are the main risks the ESRI is flagging looking ahead to 2025?
They talk about notable downside risks, and a really big one revolves around the U.S., potential policy shifts there, especially with the new administration.
Oh, okay. Trade worries, tariffs, that kind of thing.
Yeah, concerns about potential protectionism, like proposed U.S. tariffs. And for Ireland, our connection with the U.S. is just massive. Trade, investment.
Huge partner for us, especially exports, right?
Totally. Direct goods exports to the U.S., over 31% in the first 3 quarters of 2024. And if you just look at pharmaceuticals, it's even higher, over 38%.
38%. Wow.
And we run a really big trade surplus in goods with the U.S., somewhere between like 6 and 9% of our entire GDP. It just shows how, well, dependent we are.
And it's not just trade, it's the companies based here, too. U.S. firms have a massive footprint.
It's quite staggering, actually. By 2023, U.S.-owned companies accounted for 32% of Ireland's net national product.
32%, that's huge. Up from what?
Up from 21% just 10 years before, in 2013.
Incredible.
And then there's corporation tax. The reliance there is, well, stark. In 2021, U.S. firms paid over 10 billion.
10 billion euros, out of a total.
Out of a total just over 12 billion paid by all foreign multinationals combined.
Okay, So, if U.S. policy changes affect those companies, how they structure things, where they book profits, or if tariffs hit their exports from here.
It could have a really significant knock-on effect on Ireland's public finances. That's a core concern in the commentary. Things like pushing for IP to return to the U.S. or higher tariffs.
It's that corporation tax windfall we've been seeing. It suddenly looks a bit more vulnerable.
That's the worry. They also mention, the ongoing global stuff, Ukraine, the Middle East as potential headwinds, but the real focus for 2025 risk seems to be the U.S. policy angle.
But despite all that uncertainty, the base forecast is still for export and import growth, assuming no major policy earthquakes.
Yes, that's right. Assuming no massive shifts in trade policy, they project total exports up almost 10% in 2024, then slowing a bit to just over 4% growth in 2025.
And imports rising too.
Yep, imports expected up around 8% in 2024 and nearly 6% in 2025. So underlying trade flows still look fairly resilient, for now at least.
Okay. Let's pivot to housing. Feels like prices just keep going up, even with all the talk about supply. What's the ESRI take?
Yeah, it's a persistent issue. They note that while completions, the number of homes actually finished, did pick up in Q3 2024.
All right.
The overall number for the full year 2024 is likely to be pretty similar to 2023. So supply constraints are definitely still biting.
And prices still rising year on year.
Yep, continued year-on-year growth through 2024, which inevitably leads to those questions about, sustainability. How long can this go on?
Are we talking bubble territory? Is there a risk of a crash like, 2008?
Well, they try to assess that using their models, and the analysis based on data up to Q2 2024 suggests prices were potentially overvalued by about 8 to 10%.
8 to 10% overvalue. Okay, what does that mean practically? Is it danger zone?
It's not necessarily signaling an imminent crash, but it does flag a vulnerability. It means prices might be a bit detached from underlying fundamentals like incomes and rents.
Did they compare current metrics like price-to-income ratios to previous periods, like the 2008 peak?
They did. They looked at things like price-to-income and price-to-rent ratios. They are higher now than they were in, say, late 2016, which was seen as more stable. But crucially, they're still well below the really high levels we saw back at the peak in 2008.
So, signs of strain, maybe, but not quite the same level of danger as before.
That seems to be the assessment. Vulnerable? Yes. Precarious like 2008? Probably not yet, but definitely something needing careful watching.
And they also mentioned something about consumer expectations, particularly around interest rates influencing house prices.
Yeah, that's interesting. They looked at data from the ECB's Consumer Expectations Survey. It seems that what people think is going to happen with real interest rates significantly affects what they expect house prices to do.
So if people expect mortgage rates to fall,
They might be more inclined to bid up prices now, expecting them to rise further. That could be part of what's been driving recent price increases.
right, and given all that, the overvaluation signal, the role of expectations, what's the advice to the central bank on mortgage rules?
Basically, caution. The ESRI suggests the central bank should be pretty careful when they review the mortgage lending measures, considering these signs of potential overvaluation and the sensitivity to interest rate expectations.
Made sense. Okay, let's talk inflation. The story there has been a slowdown, right?
Definitely. Good news on that front. Inflation has continued to fall. CPI was down to 0.7% in October 24.
And the HICP figure, the EU comparison one?
Even lower. It hit 0.5% in November. So Ireland's inflation rate is now actually below the EU average.
That's quite a turnaround. What's driving it down? Is it just energy?
Energy is a huge part of it. The housing and energy component, which was soaring before, is actually showing negative price growth. Now prices falling year on year.
Right.
That's been key. Restaurants and hotels inflation is slowing too, but maybe not quite as fast. And transport inflation seems quite volatile, bouncing around a bit.
So overall, the expectation is for inflation to stay low.
Yeah, the forecast is for CPI inflation to average about 2.1% for all of 2024, and then drop significantly to just 1% in 2025.
And that feeds into real wage growth, presumably.
Exactly. Low inflation plus expected nominal wage increases should mean people's purchasing power continues to improve.
Okay, good news. What about the labor market? Still strong.
Very much so. Unemployment was really low in November 2024, just 4.1%, and employment numbers keep growing.
Still adding jobs then.
Yeah. And interestingly, the ESRI analysis suggests that most of the economic growth we've seen since 2020 hasn't really come from productivity gains. It's mostly been driven simply by having more people working, more labor input.
Okay. And that strength is set to continue.
Looks like it. The forecast is for that real wage growth we mentioned to carry on into 2025.
Hmm.
The market might be slightly less tight than it was and maybe a tiny bit easier to hire,
Uh-huh.
but it's still considered tighter than the average through the 2010s. They're forecasting unemployment to average 4.3% for 2024, maybe dipping slightly to 4.2% in 2025.
Still very low historically.
Absolutely.
Right. Finally, public finances. Lots of talk about strong tax takes. What's the latest picture?
Yeah, exchequer receipts have been really buoyant up to November 2024. Income tax, VAT, and especially corporation tax have all shown massive growth over the last decade or so.
But it's that corporation tax again, isn't it? The big question mark, especially with the U.S. situation.
Exactly. That's the key uncertainty hanging over the figures. Future corporation tax revenues are, well, less predictable because of those potential U.S. policy changes.
And because so much of it comes from just a handful of big multinational firms.
Precisely. The report highlights that concentration mainly in ICT manufacturing and pharma manufacturing. They're potentially more exposed to global shifts or tax rule changes.
And the overall budget balance for 2024.
Well, the headline number looks very healthy, but it's boosted by those one-off funds related to a European court judgment.
Right, the Apple funds.
Yeah. If you adjust for that, the underlying surplus, the general government balance, would still be positive, but smaller, around 1.9% of GDP.
Okay, and looking ahead, budget 2025 involve more spending.
Yet, increases planned for both current spending, day-to-day stuff, and capital spending, infrastructure investment. Plus, the government setting up those new state investment funds.
Using some of the surpluses for the future, yeah. What about the national debt level?
That's been heading in the right direction. The debt-to-economy ratio, whether you measure it against GDP or the more domestic-focused GNI,
Gross national income, yeah.
that ratio has been falling. And it's forecast to keep falling into 2025. They predict the debt-to-GNI ratio will be down to around 67.5% by the end of 2025.
So, finances looking generally okay, but with that big caveat about future corporation tax.
That's the summary, yeah. Healthy now, but with a significant point of reliance.
This commentary also had a couple of extra bits, didn't it? A research note on labor share.
That's right. It looked at the proportion of national income going to workers as wages. It's tricky to measure accurately in Ireland because of all the multinational effects distorting the standard figures.
So you need to use things like GNI again?
Exactly. They stress using modified gross national income, GNI, for comparisons, and they propose a new way of looking at it by sector, the bottom line. Using their method, they don't actually find evidence that the labor share in Ireland has declined since the late 90s.
Interesting. So despite perceptions, workers' slice of the pie hasn't necessarily shrunk, according to this analysis.
According to this specific methodology, yeah.
And there were also two special articles, one on Budget 2025's impact and one on European house prices. Quick takeaways.
Okay, the Budget 2025 one looked at who gained from the tax changes, welfare increases, energy credits, etc., permanent measures, broadly progressive, bigger benefit for lower incomes. But when you add in the temporary measures, the picture gets a bit more uneven. And interestingly, they reckon that overall, households might actually be worse off now compared to if benefits and tax bands had just kept pace with wage growth since 2020.
Okay, and the European house price one?
That used survey data. Found that people's expectations about house prices across Europe aren't always strictly rational in economic terms. What they expect for the wider economy, and especially for real interest rates, really influences their house price forecasts.
So sentiment plays a big role.
A very big role, it seems.
Right. So let's try and wrap this all up for our listeners. What's the essence? Strong underlying domestic economy.
Yeah, resilient domestic demand, definitely. But with those potential clouds on the horizon, mainly from the U.S. policy side.
Housing market still tricky, signs of overvaluation there, though maybe not crisis levels yet.
Complex picture. Yeah. Inflation way down, which is good news.
Labor market still very strong.
Yep. Robust jobs market.
Yep.
And public finances looking okay for now, but with that significant question mark over future corporation tax.
Okay, so hopefully this deep dive has given everyone a clear, concise overview, a shortcut to understanding these key ESRI insights.
Yeah, cutting through some of the complexity.
So maybe a final thought to leave people with. Given those signs of overvaluation in housing and that heavy reliance on U.S. economic policy, particularly for tax revenue, what proactive steps might Ireland need to consider? How do we build on our domestic strengths while maybe, buffering ourselves a bit better against those external risks? Something to ponder.
Definitely food for thought.
Thanks for joining us for this deep dive.